In this video, we're going to look at the difference between lump sum versus dollar cost averaging investing in the stock market. Stay tuned. Hey traders and investors, a warm welcome to you. Okay, so what are the distinct differences between lump sum investing in the market and dollar cost averaging? Let's just explain the two broadly now. So let's say you came across £10,000 or you had £10,000 given to you or whatever it was. You had £10,000 and you wanted to allocate that into the stock market. You have got a couple of choices. Number one, you go into the stock market, you say, hey, here's my £10,000 and you buy one stock or you buy a broad selection of stocks or you buy a broad selection of assets, whatever it may be. Or you say, okay, I'm going to use what's called dollar cost averaging, take that £10,000, allocate £1,000 a month for 10 months into exactly the same instrument that I was going to buy with my £10,000 lump sum. So that could be still be the same thing, one share, one stock, a broad selection. It's not the choice that the difference is now, it's the timing of when the asset is purchased or when the stock is purchased. So the difference is the spread of time versus lump sum. Let's have a look at the difference between the two. Okay, so dollar cost. The advantage of dollar cost averaging is that you're reducing the market timing effect. That's the biggest reason to do this. You are not trying to time the market. So if you're at highs and you put all your lump sum in that, you get a 20% drawdown, you're gonna lose 20% of your capital. If we're at highs and we start to draw down, your average price is going to be at different levels as the price comes lower. So it dampens down that effect. Obviously, if the market continues to go higher after you've bought, you're going to make far more from the lump sum investment than you are from the dollar cost averaging, but it's going to dampen down the risk and it's going to dampen down the noise. And actually, you might do this over a longer period of time or a shorter period of time. The thing is, you're allocating the same amount of capital, the same time-stamped monthly increments or quarterly, however you want to do it. Most people do it monthly over a set period of time until that full capital that you're going to allocate has been allocated to the stock. So that's the main thing. You don't have to worry about the market timing. And it's not just the fact that not just the point that from a financial perspective, but also from the pressure. You haven't got the pressure. Once you've done your research and decided which stocks you're going to buy or which fund you're going to buy or which ETF you're going to buy, whatever it may be, now there's no more pressure. It's a case of, hey, you know what, I know I'm going to do this on the first of the month, every month. That's it. It doesn't matter what the market is doing. I'll stick the course until I put the full 10 grand in or 100 grand, whatever it may be. If you're putting as a lump sum, you might feel the pressure of, oh, I feel it's a bit high at the moment. Oh, it's a bit low at the moment, could go lower. You start trying to second guess things. You start trying to decide, oh, I'm going to hang off a little bit. Maybe then it goes higher. And you're adding another layer of emotion into the investing that you really don't need. So that's the advantage of it. It's just systematic. It is what it is. You feel more comfortable doing it when it's high, because if it goes lower, you think, okay, I've only got a tenth of my position at the high. If it goes higher, fine, I've got someone. It just dampens all the emotions off. But one thing to note is, historically, you get better returns from sticking a lump sum in. Why is that? It's because the capital starts working, in inverted commas, immediately. Now, these are statistics taken from a long period of time. This graph here is showing you the US market from 1926 to 2013. If you'd gone all in with a lump sum, you make average annual return of 12.2%. If you've gone in dollar cost averaging, you would make an average annual return of 8.1%. If you've gone all in cash, and I think that was a 3-year treasury bill, you would have made an average annual return of 3.6%. So over that pretty long period of time, all in is better. And the general thing that people say is timing is not as important as time in. In other words, the longer you're in the market, the more likely you are to make money. Now, from my perspective, when I look at that, I say, okay, that's all very well. I know we're going back a long time there and historically that looks great. I can't help but think if you went all in a period of time that was just unlucky for you in a 10-year period, you'd end up losing money. as opposed to if you dollar cost averages, maybe if dollar cost averaged over a year period, you'd end up making money. I'm sure there are examples where, I guess it depends on how long your thesis is, how long you expect to hold it. If you're talking for a 20, 50 year holding period, then, you know, stick it all in. You're not going to probably worry about it drawing down and going against you for a couple of years, or even straight away. You know that over the 50-year period, with any luck, you're going to have a nice lump sum at the end of it. If you're maybe looking at a 5-year period, then perhaps you need to consider, hey, maybe I want to spread my risk a little bit. Maybe I do want a dollar cost average, but then you need to say, well, actually my money's not going to be working for me as quick. I need to get to work quicker, so I've only got 5 years. These are the things you have to weigh up. Timing the market, that's a different mental approach. That's something you've got a bit more kind of analysis to do, a bit more pressure to do it. Dollar cost averaging, very, very simple to do, less pressure on you, just decide to do it, it is what it is. So that's what it is, guys. Those are the stats over the long term. It's better to go all in. But, you know, if you're someone who's concerned about timing it, or you're concerned about where the market is, you might consider, hey, let's go dollar cost averaging. Let's just spread the risk. Let's spread the entry, sacrifice the fact that the money's not going to work for me as long as it would do if I went all in. But it might be less risk for me if I'm timing it badly, if we get a bit of a downturn. Dollar cost averaging versus lump sum investing. All right, guys, take care. Keep the risk manager, whatever you do. See you next one. Bye-bye.